Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, passive, just curious, or you've been in the industry for decades, well, this is the YouTube show and podcast that we have designed especially for you to get you the most up-to-date and important information related to the multifamily industry, commercial real estate, and the economy. We're going to be giving you, again, the information you need to make some really smart and informed investing decisions. Great reports today. Going to be talking about rent growth from CBRE, Marcus & Millichap, Yardi Matrix, and National Association of Realtors. Going into that CPI print that came out from the Bureau of Labor and Statistics. Just yesterday, we're getting ready for Mr. Jay Powell, Chairman of the Federal Reserve, to give a press conference here later today. We anticipate a 50 basis point rate hike. If something other than that happens, well, it'll be quite a big news. We'll give you an update. Let's break into it, get into it. Welcome to the Great Report. All right, everyone, welcome back to the report. Again, joining us, as he does every week, except for one time. Matt was sick.
Yep.
Matt Bosnaco, Director of Communications and Marketing here at Gray Capital. Matt, how's your week going? How are you feeling? What's your state of mind?
I'm going pretty well. You know, like I said, like you mentioned earlier, we're kind of looking to the future.
Yeah.
This is the week where everyone, it's either they come up with their top 10 lists at the end of December, or they get their predictions for next year. Mm-hmm. We'll have a lot of articles up until mid-January, I think, of like, here's what to expect for the new year.
Yeah.
But it really started a flood, and there's other stuff like the Chat GPT that I've been thinking about, and it's not time to be scared. You got to kind of have to come to terms with it because it's coming. A lot of things in 2023 are going to come, and it's better just to get used to it than to try to run away from it.
I agree, and I think the most optimistic viewpoint right now is that that we maybe are getting back to a little bit of normalcy. You know, when I saw the print of CPI, the Consumer Price Index, come out yesterday. I went on. We'll take a look here in just a second. But I remember, I looked at it for the print for November, and I looked back to previous years. Going back the last 5 or 7 years, a very kind of typical November rate of growth. And then thinking about that, the two buckets that were growing, food and housing. I can't speak so much for food, but at least housing, we've actually seen a lot of declines and negative growth the last quarter or so. And so, we've talked about the way CPI calculates housing, not the most intuitive, up-to-date number. So in the reality, maybe we're seeing a little bit of actual deflation, and what the Fed has been doing with raising interest rates is actually having an effect on the economy.
Yeah, I think that seems very likely. It's starting to strain credulity at this point that the Fed will have no effect, and it's been steadily raising interest rates for the better part of a year, and so I think that now that we're really starting to see it, and it's not a case where jobs are shedding left and right. It's things are tightening a little bit, and I'm not going to say soft landing and mean it, but it definitely looks a lot more likely that things are going to ease up rather than crash down to earth.
Matt, let's actually just go in and take a look at this report real quick.
Yes.
Because you see here, so we're 7% year over year, November 21 to November 22, 7.1% increase. Now that's a lot, but we had a lot of growth earlier in the year, in November last year, but only month over month, it's actually negative. I think we're at a point where folks, not just in the investment world, the business world, but people all over the world are starting to feel the pain of these higher interest rates. Immediately, first-time home buyers trying to buy a home. Obviously, they've been feeling pain for a while. People in the tech industry who are going through layoffs because their valuations are all messed up and they've got too many people, and just non-profitable companies aren't in favor right now.
Yeah.
But with the higher interest rates and with that, the strength of the U.S. dollar, the individuals that are really going to be affected, it's not just individuals, but it's the developing world and a lot of much poorer countries that are having to import everything's, almost everything is based on the U.S. dollar. That makes things more expensive for them. They're loaded with debt already. Many of these countries are almost insolvent. And we've been in a free money, zero interest rate environment for so long. A lot of things have been able to get by, but now they're having to. The cost of that debt and carrying that debt has increased, significantly. And so for a country like the United States, we've got our $30-some trillion debt. That's not going to be easy for us either, because as that debt rolls over, we're paying a higher interest rate. But again, think of these like small countries who have a ton of debt.
Yeah.
Their interest payments are going up. They're not going to be able to afford they can't afford anything. They can't afford these new payments. So there's people, countries, institutions are starting to feel pain. Mm-hmm. And they're looking at the Federal Reserve and central banks, but especially the U.S. Federal Reserve. They're saying, enough is enough. Your goal of slowing down the economy and getting inflation in check, you take a bow. You've done a lot of that.
Yeah, it's interesting because I said this before. I always think of raising interest rates in the terms of like buying houses. Well, less people will buy houses.
Yeah.
But it is really the aggregate of all of these small decisions that people and businesses make. Do I want to put this on credit? No, that's going to be a little bit more expensive to me. Yeah. And I think it's starting to catch up. Mm-hmm. So whether it's businesses that want to invest in a new department or or they want to found a new company and they need financing for it, or a multifamily syndicator wants to make an acquisition. Maybe they're less likely to do it at a higher price now, and they're coming down. They're like, well, I'm going to say no now until I get a lower price. Before, they were like, well, yeah.
Well, and then they can't. And they could make it make sense. It's like the returns didn't work, and you'd have to do so much speculation to justify it, and fewer and fewer people are willing to do that. There were some earlier this year that were, but I'm hearing whether it's like, seeing people, owners post on LinkedIn of being like, the Federal Reserve needs to stop this. And I'm like, well, you've got a handful of floating rate loans out there. You've seen your rates adjusted every single month, and it does suck. It hurts. But it's because we are withdrawing. We're in a state of withdrawal from being addicted to zero interest rates, free money. Mm-hmm. I mean, we've been addicted to it, and governments around the world have been, including the United States government, have been absolutely addicted to it.
Yeah.
And we're going through withdrawal, and we're seeing kind of normal economic activity and kind of the gravity exists taking place.
And I think withdrawal is a really apt term because it's not like typical psychology where everyone, it's different. And so I'm going to complain a little bit. We have had easy money for so long that
we've been dependent.
That it really has fostered some dependency.
Yeah.
And this is something we haven't seen for decades, interest rates this high. So, I think that a dramatic reaction is in the cards still.
But you're seeing, I guess, the good side of this is you're starting to see some of these signs of normalization that we're hopefully going to lead to less volatility and people being able to make decisions about the future, that's been the ice that's been thrown on everything. Is like, I can't make a major decision because I don't know the situation is going to be in 3 months.
Yep.
But now maybe they're not going to decrease rates right away unless something really drastic happens, but at least it's going to flatline and it's just going to go, it's just going to be a flat line. There's not going to be further increases. You can at least plan. Mm-hmm. And that'll allow asset pricing to finally fully correct. And I think we're anywhere between 72 and 80% of the way there for a price correction. We're seeing cap rates rise. There's still a gap in many cases, but we're seeing more and more deals now coming up of having much more reasonable cap rates. Often, we looked at a deal yesterday and it was still, mid 4 cap. I'm like, not a great location and semi-quality asset. Mm-hmm. No, we're not. Who's going to be buying? Or you certainly should be. Who's buying right now at a cap rate, 7,500 basis points lower than your interest rate right now in this environment? It's not a prudent or wise thing to do unless you really know something that everyone else doesn't. There's certainly circumstances out there, and cap rates don't mean everything, but we're seeing more mid-5s caps. I mean, we bought 6.5, almost a 6.5 cap, last week. So I mean, it does exist, and brokers and sellers are starting to understand the reality. And you're either at a point of, well, I have to sell, and it is what it is, and the market's gonna set the price, or you can hold on. And most people who can hold on are choosing to hold on, and it's creating the kind of the precipice of a great opportunity of these assets that are going to need to be sold whether it's debt coming due or some other situation where they don't have a choice. And there's going to be a lot of folks that are breaking even. Some people even taking a loss on assets. They just didn't set up the right way to weather through this storm. At the same time, there's so many buyers that are lined up ready for those opportunities. And so I think that there's going to be a very brief time of getting some really good some steals, like just blockbuster home run deals that are going to build absolute generational wealth for those people, buyers. And then it's going to kind of go back to normal.
Yeah. I think and this is something I think you said last week, is the difference between now and early in the pandemic. Yeah, there was a little bit of a wait and see dynamic now, and there was definitely a wait and see dynamic at the beginning of the pandemic. But interest rates makes the math wrong, and that's the real reality. Like, you can convince someone during the pandemic, like, you can actually say, like, these are great assets and the money's right, but now, like, the math doesn't work and you can't change those numbers. You can imagine different scenarios, but the numbers.
Yeah, in the pandemic, it was like the government's like, whoever, the banks are like, we're basically paying you to buy these assets to lock them in, and like, you have to wrap your head around the uncertainty of COVID. But if you were like us and you're like, okay, this is going to be not maybe good for the economy, but all right, people still need a place to live. These are great assets. The worst case, the big concern for a brief period of time was like, well, nobody's got a job, nobody's gonna be able to pay rent. But again, are we gonna go for a decade of no one having a job, and then the government stepped in and gave people more money than they ever made before, and which is why we're in this situation to begin with. But it's a different scenario where the money's not free. You got to actually pay up a lot for this debt. And so the business plans have to make sense. You actually have to buy right. You can't just say, well, we're going to buy it because we're going to get so much rent. We're going to get so much rent growth this year, and cap rates are going to compress a little bit more, and it's going to be worth $10 million more, even if we run it into the ground. It doesn't matter. And I can pay whatever. But now it's like, no, your basis matters. And that's where this period of price discovery that we're in right now is really interesting. And I see ourselves as great capital, an active participant of figuring out, okay, where are the price of these assets? And so sometimes we get sent deals from brokers all the time, and sometimes it's a deal that's like, we're so far away, whereas maybe it's not the perfect asset for us. But sometimes it's like, no, let's give them a price. Let's give them a price. They need to know. The brokers need to know. Yeah. The market needs to know. The sellers need to know that this is where we are. And we're not just tossing just stuff on the wall. Yeah. We've got very empirical and straightforward numbers driven reasons of why the price has to be where it is. And it's $8 million different, but we're not the only ones seeing this, and you need to know this is where the market is right now. Yeah. So you need to come closer to us, or you need to decide not to sell. But we're certainly not a buyer at a 4 cap for
and that is a really good point. It's like it's not like it's not like the price of a value meal at McDonald's, where like these things are turning around so much and so quickly you can kind of reach an equilibrium. Like there are a half dozen or a dozen buyers sometimes, maybe less, maybe more. But that's each one of those is a significant input for things like price discovery. So
they make it. Back in 21, they might have gotten 20 offers, 25 offers, something like that. Which is a lot on a a 20 to $100 million asset. Now they're getting maybe 2, 3, 4, 5, 10 max. And so it is important, your input. And I think it's folks that are out there, they're trying to buy properties. Sometimes can be hesitant of like, I don't want to offend them with this number. Well, if you're working with, if the seller is represented by a broker, you can always have a conversation of, hey, look, this is way lower. If you don't want me to submit my number, I won't, because I don't want to offend anybody. Yep. But we've got our process. But I'm happy to share your number. I'm happy to share with you our thought process, our assumptions. We'll even share with you our model to show you exactly how we arrived at this price. I don't know how many times our acquisitions team has said, the brokers have thanked us, even though it's like, this price isn't going to work because the seller needs X. Yeah, they've said, this is really great. I need to know this because they need to know how buyers are looking at it, how the market's looking at it.
Learn if you do. Yeah, it's like you don't get the job At least you ask the interviewer, all right, what did I get wrong? Most times they're not going to get back to you, but it's a good. That's how you learn.
And then exactly, it's how we learn. It's how everybody learns. And then the broker's taking that information to the seller and saying, look, this is where folks are. It's hard for them to justify your price because of all of these reasons, and because the broker doesn't want to tell the seller, hey, I don't think your property's worth that. It's much easier to say, well, these are the offers. Yeah. Or it's like, I didn't even want to show you this offer, but, actually we had 4 come in that are, at, 10 million under. So this other price that is 4 million under is actually a really good offer. Like you should not be offended by this because the market is kind of within this range and this is the highest end of the range, even if it's at your low end of the range. Yeah. It's actually a good price. So,
and I said this earlier. It's like, I don't really envy the role of the broker. It's hard work.
Yeah.
And it's not just like, I just answer the phone and connect buyer to seller. It's like, no. You have to know so much, and you have to be able to kind of smooth that relationship and be able to communicate really accurately.
Yeah.
But in all, kind of returning back to the CPI numbers, I think they're really, they're incredibly promising, and I think that it is more of a done deal that we're going to get a 50 basis point rate hike, and I see some signs of the clouds clearing, but I don't know if we're completely out of the woods yet. Even though we might be, even if it was zero and we're kind of coasting, we're still at a high level of inflation. 7.1 year over year inflation is still big. It's got to burn off.
I agree.
A while.
I think we need to see a trend. So I think in December, which is typically like the slowest month, of growth, if we see a continued trend, if that's the case again, okay, I don't think that's going to be everything, but I think February and March, is going to be the real indicator of how inflation is going to look the rest of the year. Because March, things should really start picking up. Now but the Fed may be over with the rate hikes by then, because of the idea is maybe another 50 basis point in January, and then maybe a couple 25s. Trying to get to that terminal rate of maybe 5%. I think that would get us to. I think that would basically get us there. And so are they going to get the information in time to say we're going to hold off? Below 5%, or is 2 or 3 months enough data to show the trend? And the last thing they want to do is to have to reverse course again.
I think that they're smarter than the numbers. For CPI, especially when it comes to housing.
Yeah, it's not. Yeah,
I think they know. Well, and that's another thing too, is housing's still high. Rental housing is still high. CPI is still looking like they're looking, at a dinosaur fossil instead of what the current market is, and they're still showing housing or rental housing costs as moving up 0.6%, which is pretty significant. You analyze that, it's like 6 or 7.2, really, yeah. So it keeps plugging along, and it's bound to, within the next 3 months, start going down, because it's about like a 12-month, maybe 9-month lag between the shelter prices and when it finally circulates back into back from the interest rate hikes that we're seeing.
Absolutely, and again, it's. The shelter makes up 30%, 32%, almost basically a third of CPI. So it's not like just a minor piece that is throwing the whole number off. Again, if shelter was a more real time, higher frequency, indicator as a part of CPI, again, we would have a negative number.
We could have 0.3, 0.2, 0.3 negative. If this is a third, this is horribly bad math, but if you cut that by a third, that's like 7.1 by a third. I don't know. It seems like that's a negative. Yeah, it's less. It's less. Man, that's my liberal arts degree going.
Yeah, it's all good, Matt. That's why we got Excel. So I think we're going to be waiting out for next month's December print. We'll see if it's lower. It should be, and we'll keep tracking it. And again, everyone's waiting for Jay Powell's notes.
He makes the future. We try to predict it, but he can just create it.
Well, and again, as we've talked about it, it's so much. This is just psychology and messaging, and he has. They've done an effective job of. Starting at that Jackson Hole speech of saying no, we're doing what we need to do, and it's going to be painful. And just buckle down, because we're doing it, and we're not going to blink.
And I think that's such an important role for them is if we're treating these announcements as a foregone conclusion, then they're doing their job right. And they kind of, I don't think that they want surprises like that. And they have done a great job of signaling what to expect.
Well, I think that's the key point. If you're going to signal, you better be very clear and not move around. Well, either that or shut up. Because Fed officials in the past, used to not say anything. At all. It was here is what it is. We're going to go back into our room now.
Yeah.
So, all right, 3 economic trends to watch in 2023. Marcus and Millichap has a nice video. It's going to be posted, in the comments here on YouTube, as well as, you can check us out at grayreport.com. It's, grayreport.com is the #1 multifamily intelligence aggregator, Matt.
That's right.
So, John Chang, Matt, give us a summary. We're not going to necessarily listen to John. John's he's Senior Vice President, Marcus and Millichap, housing expert, really smart guy. I heard him saw him on LinkedIn today talking about how the CPI print, was just great news for real estate investors, by the way. But
I mean, so in this one, this broad economic overview, I think, really sets the stage with some of the projections of 2023 that we're going to cover here in a second. And they give this explanation of some of the major issues that are going to play out in many of the other reports and predictions that were published this week. John Chang breaks it down to 3: consumer sentiment, cash savings, and revolving credit. That's one collectively, and the labor shortage. Consumer sentiment is showing signs of a positive trend, despite the headwinds of inflation. It shows signs of climbing from a record low. Is one of their headlines there. Cash savings and revolving credit are not in a problematic situation right now, but the trend could bring us to higher credit levels and lower savings, which makes things a little riskier. So yes, consumer sentiment is kind of bouncing back a little. People are feeling a little bit better about purchases, but they are drawing on their savings ever so slightly. Yeah. We're not at dangerous levels right now, but the trend is there. And then when it comes to the labor shortage, it points to a strong market in the short term, and there is nothing that screams recession or anything. But it is worth noting that things could change. Either it could be pulled down by recession or recessionary forces. I think it is more likely that this shortage will ease up, and which is like a euphemism for there's going to be less jobs out there, rather than like a wage price spiral. Yeah. I think that it is so high in people's imaginations, this idea like inflation, and we saw some cutbacks in the tech sector. I don't know. I've also heard a lot that may not be representative of broader economic trends. Yes, tech sector is like 2% of the job market, which is that's a pretty significant amount, but it's not the entire economy.
I see more as on a slowing down in the pace of hiring, because companies just are concerned about inflation, or really a recession, and slow economic growth, and just battening down the hatches for next year. And so they're saying, hey, look, let's hold off on bringing on a lot of new people right now, and looking at, okay, how many people did we just bring on? Do we really need all those people? And I agree. I think the tech sector is a little bit of I wouldn't say a complete anomaly, but it's a unique case. Yeah. And on top of that, we've got everything that's going on Twitter and Elon Musk, and really significantly reducing the staff, and that's a little bit of an experiment in itself. That if that works, and a lot of tech companies are like, do we need all these people? Well,
and it's so hard to generalize between the tech sector, like you said too. And that's just what I was kind of thinking about. Well, like Twitter, there are discrete reasons. A new owner came in that made dramatic changes. What about we're talking about all the weirdness in streaming services? How there's been some kind of tension, and so there is it's not a systemic thing. There's not like some broad force. There could just be real reasons. I think what's in general, though, is a shift a little bit away from growth stocks into more value stocks.
100%. Yeah, no, I mean, a lot of that is just technical, because, the discount rate, and so you're getting paid less for growth, and people want, income now, which is why a lot of people, are attracted to real estate, because it's a cash flowing, very much value driven asset, and that's kind of the way we've always looked at it. We've been more fundamental investors rather than kind of technical and speculative. The challenge that is, obviously interest rates and, people thinking that, lumping all of real estate and housing in kind of one category and not wanting to catch a dropping knife, which I don't necessarily think is absolutely true, although, prices certainly are correcting.
Yeah. Yeah, there has definitely been a shift, and we've talked about this for a couple weeks. Things were down in the doldrums, I think, in the beginning of November and maybe a little bit in October. Like, there was some really, there were more negative than positive takes on the economy. Things have taken a little bit brighter of a turn. Again, I can't trust that things are going to be good completely. I can't trust that things are going to be bad. We're still a little bit uncertain.
Agree. So I was at a conference last week, and it was mostly family offices, wealth managers, registered investment advisors, and it was interesting because there was quite a few pollings of the room. Raise your hand. And everyone really believed that there's going to be some sort of recession in 2023. Most likely, but what that looked like and what that means for the future, there was really kind of a 50-50 split between on one side, mostly optimistic that there's going to be a recession and a downturn, but we see a lot of positive signs and opportunities. And then the other half is no, the world is going down. And I attended two kind of presentations, one on more of, I would say, the optimistic view. That wasn't really, normally in normal times it would not have been considered an optimistic view, but I think a pretty kind of straightforward view of things are rough right now, things are being shaken up, but, we're probably going to get through this, and, it's not going to be the end of the world. Yeah. And on the other side, it was, we're looking at the end of the world. And but what I found is that really two takeaways. One, at least the presentation I saw on kind of the worst case scenario end of the world, what really was not that convincing. You can paint a picture, and you can always paint a picture of absolute worst case scenarios, but the evidence just was not convincing. The story was I don't know. It was kind of hard to follow.
So I was listening to a podcast where it was one of the former CEOs of PIMCO, and he was talking about, a doom and gloom kind of how things are really going to crash. And the way that he described it, it wasn't necessarily, and it would, by his explanation, result in economic downturn, severe or however. He didn't. I don't think that he really indicated that it would be like the Great Recession levels, but he definitely said things are going to get bad. But the way that he described what is going to happen, it seems more like things are going to be different. Maybe not so bad, but things are going to change. Yeah. Primarily, he was talking about a shift from just in time to just in case. So we're relying on the ease of shipping lanes, and now maybe there's some nearshoring, some more domestic investment in manufacturing. And stuff,
and we're definitely seeing that.
Which to me, it's that could bring jobs, and again, that may be some inefficiency in the near term, but it's not like we're going to be picking up the rubble after the world has collapsed. That's not what we're going to be doing in 2023. We're going to be doing things.
No, the pendulum continues to swing, and and we went from everything being offshore to now being well, maybe that doesn't make that much sense for everything, and maybe we need to continue to make some things here. That being said, there are going to be markets where you can make stuff cheaper, and it's always going to make sense to really have a free market. We have to find places to produce things cheaper, to have cheaper things here, because if we make everything here, things are going to be more expensive, and it is going to be inflationary. But it does make sense to make some things here, not rely on every other country.
And I forget if you mentioned this last week or not, but shipping's getting cheaper, and really this month and maybe last month a little, we're really starting to untangle that whole thing, because when everything stops, you got to get that engine running. Someone's got to take the load of oranges from Florida back to Indiana, and then they take the corn down, and then when there's a truck ready for you,
it flows. And it flows when there's that. There's enough set buyers for the sellers, but when you only had one truck running and there was one crate of oranges, and everyone's buying, those oranges got pretty expensive. Pretty quickly.
Exactly.
And at least that pressure seems to be gone. Plus, energy's way down. Energy's been down, month over month for several months now. which is, I mean, great news for Europe. I mean, all the articles about, the horrible situation. And your energy prices in Europe are still, a couple times higher than they are in the United States, but it's not worst case scenario. And we're still early into winter. So, we're not out of the woods yet, but things are looking a little less hyperinflation-y than they were potentially a couple months ago. But I do think that we're not going to go back to, zero inflation next year, because like the onshoring is inflationary. A lot of these policies are relatively inflationary. I think there is going to be some wage price. I don't know if I think spiral is not the right word, but I think that the wages are going to have to continue to adjust, and we're seeing wage growth, like around 5%, but we need to see probably a little bit more. But like we've looked at in many reports, like the rent to income levels are kind of in line, so we're not too far out of whack. But yeah, and again, I am usually an optimist. I like thinking about the worst case scenario, and I like, when we put our deals together, I like to assume that I like to make assumptions that will get us through any type of environment. But in general, I'm an optimist, and it's funny thing about investing in apartments. And I go back, 7-8 years ago when I really started getting into large multifamily investing, and having conversations of, it's all worst case scenario. What if this happens? And what if hyperinflation happens? What if the government does this? And the painting the scenarios where like multifamily apartments like just don't work and it all fails is, we're painting scenarios where like everything is failing and going to zero. Not that you can't mess things up and not operate, and you can overpay. There's still all kinds of risks. But if you do the basics pretty well, and you don't speculate too much, and you buy right, it's hard to really mess things up over time. It's hard to lose. Not that there isn't risk, like 100%.
Well, and you can think of it in other ways, like better or worse, but things are going to be different. And even if things are going to go down, there are going to be people that are making money off of that downturn. Some way, somehow, there's going to be some markets that are going up.
The largest fortunes are always made in these types of environments. And with a downturn, or just things are tossed up in the air and things are up for grabs.
Whenever anyone points out like how much money you can make at the stock market, they always say, if you invested at the bottom of the depression or something like that. So, so we may be reaching a moment where, there's equal opportunity as much as there is, maybe a present downturn.
Yeah, absolutely. Sorry, I love that video, Rona. We just got into such a good conversation, man. All right, let's talk about the National Association of Realtors, the research group on the horizon, markets to watch in 2023 and beyond. Again, talking about the future. That's the kind of the theme for today. So this is a little bit of a light article, and then we can follow it up maybe with a little bit of discussion about the CBRE link, which I don't have pulled up, but I'll get that pulled up. NAR does its own stage setting, as much as the Marcus and Millichap set the stage, calling 2022 the year of softening. Like a sweater, maybe? Like dryer sheets? I don't know. I think it's the year of moderation. Fabric softener?
I think the year of moderation seems a little bit more appropriate with inflation as bad as it is. But after a little preamble, NAR explains the criteria that they use to pick the markets to watch in 2023 and beyond. They're really talking about the housing market. And
really single-family homes, right?
Yes, exactly. Yeah. But I think that this does relate, and I'll get into that in just a second. So they're looking for markets with better housing affordability than the national level, more renters who can afford to buy the median-priced home than the national level, stronger job growth, more tech jobs than the national average, stronger in-migration and population growth, a lot of remote workers, faster growth of active inventory than the national level, and a smaller housing shortage than the national level. For this last one, really, they argue that people are more likely to buy a home in a market that has more homes than one that does not, which clarifies things a little bit, I think, and reemphasizes the fact that they're looking for markets where people are most likely to buy a home. A lot of these indicators will also point to strong rent growth in their markets to watch, but again, they're really looking for this volume of home sales more than anything else. So what are these markets? I'll name them. Atlanta, Georgia, Raleigh, North Carolina, Dallas, Texas, Fayetteville, Arkansas, Greenville, South Carolina, Charleston, South Carolina, Huntsville, Alabama, Jacksonville, Florida, San Antonio, Texas, and Knoxville, Tennessee. All these markets are arguably within the Sun Belt. Knoxville could be a stretch since some maps put Tennessee in the Sun Belt and some don't.
I think it's
for the rhetorical purposes I want to make here, I'm lumping Tennessee into that sunny American belt.
Yeah, Nashville.
Again, like I said, it's important to distinguish what the purpose of this is, but it makes sense to expect people to want to live in the South for the same reasons that people want to live, that they wanted to live there in the past few years. The Midwest probably won't be sitting at the top of rent growth lists forever, but if history's any guide, Midwest is still going to stay stable. I think that this is more of a case where people are coming back to the Sun Belt, but maybe not in the exact same markets. Like maybe they're not going to Phoenix. I know Boise's not in the Sun Belt, but these active markets, maybe they're going to avoid them, but go to a place that has similar amenities in a similar location.
Well, I think it's the trend is your friend, and these are all popular metros for one reason or the other, and I would say jobs is the underlying theme of all these. All these markets have great job growth, great population growth, and population growth usually follows the job growth. They're all in moderate climates, so it makes a lot of sense. Just because people are building a lot in Greenville or Dallas or Raleigh or Atlanta, that means there's demand. People want to live there. And can you build too much? Yes, but if you have enough growth, typically there'll be a short-term issue. Now it can be a very bad short-term issue, and I think markets like Phoenix, that's not on this list, are kind of going through that and Austin, a little bit of a price correction from prices and rents because they just were flying so high. But in 2 years from now, we're going to be talking about Phoenix on top, probably next year, on top of rent growth, once again. So I think this makes a lot of sense. Again, this is specific for single family homes, but I don't think the Sun Belt is. There are reasons why Sun Belt versus the Midwest versus the West versus the coast or primary gateway markets. There's pros and cons. I would say that the Sun Belt is definitely the consensus trade, and it is the easiest to make sense of because the migration story, the job growth story makes a lot of sense. You are paying for that story a little bit, but people have been very successful over the last cycle and continue to be investing in these markets. Yeah,
I agree. I think we looked at a place in Greenville too.
Yeah, Andrew. We made offers in Greenville and Charleston, and again we're mostly focused on the Midwest, but we track markets all across the country looking for opportunities. Huntsville is a market that we looked at a lot. Just to us, sometimes the pricing gets to a point, the cap rates are so low where we have to look at it from one, cash flow is not as good. There's growth there. If we speculate, we can show good IRR, but we're cash flow investors, so it's tricky. And then just what's our tactical advantage? What's our competitive advantage versus everyone else that's going to be going to that market? And I have an on the field competitive advantage in the Midwest, especially in markets in Indiana, Ohio, Kentucky, Michigan. We go down to Knoxville, Tennessee. That wouldn't be as bad, but let's say we go down to Dallas is the best example. There's so many good operators in Dallas. I'm not going to be able to compete with them, even though we've got a great platform and run things great. But I don't know the market. I mean, I have family in Dallas, but I don't know the market. I'm not going to know the market like some of the folks that have been buying and operating real estate in Dallas for a decade or two. So I would invest with other folks in Dallas, but I'm not going to go to Dallas because I don't have a competitive advantage.
And this is, something I think I remember talking about this a year ago on the Gray Report, but growing up in a city, you don't know if that flashy little submarket is something that's kind of a flash in the pan or if it's got some real legs. So there's some intangible factors that come with market knowledge.
All right, Matt, this brings up the CBRE report that I want to move to. They've broken down the chapters. It's an interesting way that they've organized this report. And again, you can go to grayreport.com, subscribe to the newsletter at graycapitalllc.com/newsletter to learn more. But let's talk about their, I guess, second chapter in their report is the economy and policy.
So their the total report is the U.S. real estate market outlook for 2023. CBRE, in their overview, they said that it estimates 55 minutes to read. I won't spend 55 minutes talking about it.
That's why people subscribe to the Great Report.
That's right. But I do want to say that, we're dealing with a very extensive piece here, and we won't be able to cover like every single aspect. So with that being said, as a smooth extension of the economic stage setting that we just had, we can jump right into this economic outlook for 2023. There's going to be a recession, they say, but not a deep one. CBRE has a table, which I think is really helpful, showing their quarter-by-quarter forecast for GDP, federal funds rate, and unemployment. It looks like inflation will trend downward to 4.1 by end of year 2023, but unemployment could go up to 4.7, and the federal funds rate could stay around 5 to 5.25% by the end of 2023. Not ideal. They say shallow, but I don't like I don't like the interest rates staying that high, and the fact that unemployment could go up a full percentage point by the end of the year. That's a little bit of a bumpy road. It's not the rosiest of scenarios.
I agree. Unemployment at 4.7% historically is really not that bad, though.
Yeah, that's true. Yeah, typically, in all, it's about a little bit on, not even on the upper range. If you look at the,
now, I forget which economist was saying this, but they were. They're like, back in I think it was the Carter administration, they're like, our dream was 5% unemployment.
Well, there's this idea of replacement employment or something like that, where you have to have a certain level. Now, I'm not sure if it's 3.7, 3, 2, or 5, where there's enough, almost like liquidity, where people are moving in and not getting locked in, and the availability of people and of jobs is reaching that kind of balance. But again, I think that, you are right. Historically, 4.7 is not too bad. They go to great lengths, I think.
And that's also in the context of a recession.
Yeah, that's a good point.
That 5% in good times would be good.
Well, it's funny because, we were talking. It seems like people forgot that there was a little bit of uncertainty. Like, were we ever in a recession in 2022? Because now a lot of the economists and articles are like, oh, could there be a recession in the future? I was like, what were we doing in 2022? The stock market went down, and that. But
and 2 consecutive quarters of GDP growth. I guess there's some technical reasons why maybe we weren't, because of like some demand some things being carried forward from last year. But I agree. It's like it certainly in many ways felt like a recession. In other ways, not at all. But that's why everyone, I don't think, has been able to make heads or tails of it. But it's not been good.
Yeah, exactly. So CBRE, again, they go to great lengths to emphasize that this projected recession will be short-lived. Their implication is that we're going to have a very attractive buying opportunity next year. I'm not convinced it's going to be a perfect opportunity to find and finance high-performing multifamily investment properties, only because we saw this prediction in 2020, and we talked about this really earlier in this episode. That being said, 2023's high interest rate situation is a key difference from 2020. So that could reduce competition among buyers, such that opportunities will be available, but really only for investors that are able to solve the financing challenges. So,
and I think you are going to have the cojones to step into the market, because the time to step in is not going to be when everything is all clear and it's fine. There's going to be like the storm is still going to is going to feel like it's the darkest time. The storm is raging and this is never going to end, and that's going to be the time to get in. Once the clouds clear, everyone's jumped in. Prices are going to jump back up, and so it's going to be a little bit of staying up to date, on a very high frequency rate. Which again, that's what the Great Report is for. Without it, I don't know how you could do it. And then having the confidence and the ability to execute, to move forward and take a risk. There's going to be some risk of being wrong.
Yeah, that's what I was going to say. It's like the time to jump into the market is pretty risky. We were talking last week about time in the market versus timing the market, and it's inherently risky to figure out when to jump in and when to make that.
And it's, you don't want to say we're not buying anything right now and then we'll make a decision to get back in. I think you always have to be in, and you just have to have criteria, and you have to have your standards and expectations, and adjust those, not to facilitate doing like bad deals. It's not like, hey, let's loosen up during a recession. It's no, you tighten your criteria, and that's what I've been telling our like Addison and and Jay. last year we might have been able to justify a 14 IRR if the cash flow is good and it was a great asset and we're putting great debt on it. But now we have to see 16, 17, 18, 20% IRRs and not 5 or 6% cash flow. We need to see 7, 8% cash flow.
Yeah.
Well, we haven't seen that in a long time. Well, we're doing deals, but they've got to be good deals at a right price that is attractive enough, and that the most important thing is that compensates for the risk.
Yeah.
I'm jumping in right now. The times may be tough, but the confidence comes from being conservative based on our assumptions and knowing that our margin for error is just so high. Mm-hmm. And if the next year is crap, well, it's still gonna work out because whether it's bringing on enough reserves, buying it right, the right location, being patient, and not just rushing into anything. It's not like we've decided yesterday, let's go buy some apartments on a fire sale. It's like we're always in the market buying the right stuff at the right price. Mm-hmm. You just have to be adaptable, dynamic. And what we talked about earlier is that feedback from feedback to brokers. Yeah. If you're out of the market, if your pencil's down, mm-hmm. Are you going to be the first one that they call?
Yeah.
They're going to be like, I would have called you, but you guys weren't buying anything. Mm-hmm. You guys are pencils. Oh, you're not pencils down. I didn't know.
Well, and you're not going to be on the broker's radar, but also you're not going to have a good idea. You're not going to be able to do your own job really well.
Yeah. Where is the market?
Yeah.
Where what does it look like? What do I do?
Yeah, because you can read all these reports, but ultimately having that exercise of like putting it on the line I think is really important.
I agree. But their forecast for the 10-year Treasury is
so flat.
It's optimistically flat. Because that's what we have needed is just some consistency. And who knows? I mean, that would be like a unique time history that it was that flat for so long because they don't know. And this is forecasting out to 2028. Yeah. But we're we shall see. What is this? This isn't even
well within the bottom quartile of where interest rates have been, and you look at this and it has a general trend lower and lower.
Yeah.
Who knows? Maybe we did reach bottom earlier in 2020, but I don't know.
Oh, on the 10-year?
Yeah.
Oh yeah. When it was almost like 50 basis points, I think it was like 0.4, like 8 at one point. Yeah, and then it was topped like 4.2, some change, and now we're back kind of 3.5 or so, which is totally fine. Like mm-hmm. historically, like these 10-year rates are. I mean, just look again, open the graph again. It's a run up, but again, it's like a run up back 10 years or so. But over the long term, it's a lot better than 15% 10-year Treasury rates.
Yeah.
With inflation that wasn't too far away.
Yeah.
Mm-hmm. 2023 will be interesting. And that the Marcus and Millichap, the NAR title of, the year of softening, I think it's year of transition.
Yeah. Yeah.
I mean, that's the way I see it. And, just the pendulum's shifting back and forth and just reverberations and expansions and refractions, mm-hmm. expansions and refractions. And it's a whiplash, but, we're it's like when you see you drop a stone or something into the water, and the first ripples are the biggest ripples.
Yeah,
they're the most impactful, and then as they permeate out, those ripples are smaller and smaller, and the waves are shallower until it becomes calm again.
Yeah.
So I think we're vibrating back in that.
No, I agree, and that's something that actually that the Yardi Matrix report makes emphasizes as well. If you want, we can start talking about that.
Jump right in.
Regular listeners probably have lost count of how many times the Gray Report has covered Yardi Matrix monthly multifamily research publication, but. Number one, it is an excellent detailed report. Number two, the market's always different. Yeah, it's the same report, but they're going to be talking about a lot of difference. And that's how I wrote this, especially in a transition year like 2022, following the changing trends of the multifamily market is extremely helpful. Really valuable.
They picked a great skyline to feature.
Yeah, it is. That's a Ooh, man, that's a good stock photo.
Yeah, it's Indianapolis. I think top of the charts this month.
Yep,
it's been going around the LinkedIn's and such.
For sure, and it's been about a few months. Like I mentioned earlier, I'm not sure how long it's going to stay in, but it is a virtue of its stability, and its continued stability will, if history is any guide, it's not going to rise and fall with the volatility of markets like Phoenix.
Well, it's more of like when I get the questions, because again, like I was talking to investors all last week who know us from Indiana, and people from international investors too, people who did not know what Indiana was and weren't sure what Chicago was. And so I'm like, well, if you haven't heard of Indianapolis, then do you know where Chicago is? Like, if I'm talking internationally, that's usually the line of the conversation goes. But to so many people are like, where are you investing? I'm like, Indianapolis. And they're like, Indianapolis, what's going on? Why should I invest there? And it's like, well, last week, Lisa, I'm like, well, did you know Indianapolis is like top rent growth in the nation year over year? And they're like, huh. Interesting.
And I like that. I like that fact too because of just what I said. It's like not only is it's on the top for a reason, and it's not a reason because people just are happening to move in. It's because of has this history of stability, and like they said in this articles, Indianapolis is still among the least expensive of the major metros. And it's one of the handful of markets, really less than a handful, where rents have continued to increase. Their numbers for rent growth, this is the first month where Yardi Matrix has had negative month-over-month rent growth at negative 0.5% for November 2022. Year over year is still at 7%, but Yardi Matrix is detailing the same economic context that we have covered just earlier here. We've got a little bit of inflation, a little bit of interest rates, but in their interpretation, the current slowdown is a correction from a level of rent growth that would be unsustainable under optimal conditions. Yeah. It is not, they say, unexpected, nor is it necessarily a sign of a deep recession. So this is this is the drop of the water that the water's coming up now and it's going down, and it's reaching a level of equilibrium. I would say a little bit of this is normalizing, moderating a little bit of a cool down, but it is a reaction to 20% rent growth.
Exactly. It's like what comes up comes down. Look at any type of technical analysis. It's like there's usually a reversion to some sort of mean, and the mean can move. But
and the proof is what we've mentioned before is a lot of the high flyers are the ones that are having the most anemic growth currently. Yeah. So you look at the past, huge rent growth in the past, and now it's a little bit, and that's what's really dragging this rent growth down. If everyone was steady like Indianapolis, maybe things would be different. But
it's true. In really month over month, there's only really two markets in the country that are positive month over month: Indy and New York City. Which New York was negative all of 2020
There's
and
another
part of
reaction.
2021, and Indianapolis was positive. One of the few markets that were positive during 2020. And again, that was part of the conversation I was having last week with a lot of these family offices. Is that talking about Indianapolis is that there's a consistent theme of being able to get through an economic downturn in relatively unscathed. Now, 2008 affected everything, all asset classes, all real estate, but Indianapolis was anything like a lot of other markets. Wasn't nearly as bad. Pandemic, Indianapolis was on top. Some of the least amount of job losses. So from a jobs point, very positive. And then from a rent growth perspective, near the top. I think we were number 4 in the country in 2020.
Yep.
Now, similar, 2021, we are number 1, number 2, certainly in the top 5 of rent growth, regardless of where you look. That's a consistent trend of resilience. And there's a handful of other Midwestern markets that are in there as well, like Kansas City, that has been doing well as well.
Yeah.
I'm not seeing Cincinnati on this list of month to month, but they typically do pretty well as well. Columbus, again, just a lot of other Midwestern markets are just a little less volatile, but still have really good growth. And also, there have been some adjustments to, some of the census projections. So population growth has actually, projections have ticked up in a lot of these Midwestern markets as well. And so, the counter argument against the Midwest would be, they don't have the growth that the Sun Belt does. But there's still a decent amount of growth, and it's maybe not as much as in Atlanta or in Austin. I mean, Indy's never going to be in Austin. It's not going to be in Atlanta necessarily. But that's okay, and that's where I think it's much more niche tactical opportunity.
Yeah.
But
well, and
riches are in the niches.
And I think it's worth emphasizing that these are affordable markets as well, and that could be a big driver and maybe not a driver of rent growth, but certainly a driver of kind of stability, like this backdrop of stability, because it's so affordable.
Yeah.
You would expect people to be able to sustain themselves and to live in, and to not be pressured like some of the renters or homeowners in other markets and other states and stuff.
Agreed. Just looking at renewals, unsurprisingly, renewals have started to come down a little bit. This is for existing residents re-signing a lease. They were, still the rate of renewals are still high. I mean, the renewal rates, the mid 60s in the past, our average would be about 50%. You'd assume 50% would leave, 50% would stay. The fact that we're kind of still 60s, Baltimore 70, Indy 64, Sacramento is basically 60. That's really strong. And then the increases are also quite high. Really in this top 15 or so, kind of 10 to 20% renewals. That would be huge organic rent growth because, again, typically on a renewal, you're only increasing like 2 or 3%. So I think this is the one we're going to see this continue to a point until more rents are caught up to market.
Yeah.
But I think that's going to be an interesting story where a lot of the growth is going to be coming from getting these older leases back up to market, not as much on pushing market rents. Because I think there's a feeling of, all right, we push market rents so much in 2021. Mm-hmm. Let's just kind of get everybody else up there. Let's take a pause. We're getting rents significantly higher than we thought we were going to be right now. Mm-hmm. So let's be happy with that. Now, expenses are rising also, and that's the other thing that's like, rents are only one side of the story. Mm-hmm. You got your revenue, but then you got your expenses. And, utilities, we've talked about energy being cheaper. Utilities have not gone down anytime soon. Utility costs are just tough. Payroll, it's not going down anytime soon, especially when you want the right people. You have to pay up for the right team, and nothing can improve or completely throw a wrench in the gear of a business plan is not having the right people in the right place. Mm-hmm. Not to mention labor and other types of materials that are just more expensive.
Yeah.
So it's going to be a challenge trying to see positive NOI growth.
Well, that's what I was
without organic growth.
So in CBRE's multifamily section, they project 4.3% rent growth, but they also project 4.1% inflation. So we got 0.2.
Yeah,
that's not a lot of point.
Nope. No.
But yeah, so the other thing that I wanted to note, and this is for avid readers of this report, if they scroll down to the rent to income chart that Yardi Matrix uses to kind of track affordability. Kansas City and Indianapolis used to be like specifically and reliably at the bottom, but I think that there was some shakiness in the reporting this week. Specifically, you're looking at Atlanta, Denver, Dallas, and Chicago, and they have an average that is much lower than what I think should be.
Do you think, again, this comes back to how they're calculating a renter by necessity and lifestyle units? And because it's interesting, renters by necessity was renters by necessity versus renters by choice. And I think lifestyle units, luxury renters by, it's kind of the same thing. But with the rising costs of mortgages, you're just having more and more people who are still doing pretty well, but they are a renter by necessity. And they may want to live in a lifestyle unit, though. That's where
maybe there's a higher weight to the renter by necessity now. But again, like here, I'll use an example. If you scroll down to, I think Dallas here. They say Dallas that the average rent to income is 21.7, but on the other hand, the renters by the lifestyle renters have a 32.7 rent to income ratio, and the renters
in Denver, yeah.
Oh, that's Denver. I'm sorry.
No, but it's the same story. So I guess for lifestyle, it's 32%. For renters by necessity, it's 29%. So how's your average?
21.7.
21.7.
I think there's got to be some.
So is that like including affordable? Because like certainly it's not an average between these two. So what are the other categories? Is it affordable units?
All I'm saying I am telling readers, if they read this thing, the last 4 things I would put an asterisk on and say maybe those don't belong there. Where it starts getting true, where it starts making sense to me is at Kansas City, where 24.6, that seems reliably between 23% and 25.7%. So that's starting to make sense there.
Like Indy, renters by necessity 27.4 and lifestyle 24.5, which is higher than the last report we looked at. So the average is 26. Okay, yeah, that makes sense. That makes sense between 24 and 27. Yeah, 26.
But Baltimore, I don't get it.
So Baltimore. For renters for the lifestyle renters, 35%. That's cost burden. Anything over 30% is cost burden. 33% for affordable units, but their average is 25.
I may have to contact ERD Matrix.
We're gonna have to contact ERD Matrix.
Yeah. So I don't know if you want to get to the fun part of this Gray Capital Gray report.
Yeah, let's get into the fun stuff. Okay, so we've been having some fun. I was having some fun yesterday and the day before. There's a lot of talk of this Chat GPT, this AI little chatbot. And I'm like, okay, yeah. At first I was like, I don't get it. Chatbot's been around for a while. It's like Siri. Why is it that interesting? It's a free tool. It's so popular right now that it's crashed the server. Because we were going to do it live while we were recording. And we're going to try it real quick just to see. Because it's really cool. There's a cable log on it.
Yeah.
And what are the applications for applying AI and
just in some of the notes that I have, it's this technology. It's currently available for free public use to anyone that signs up for an account. They have been really swamped with requests for their little AI machine. But it is fun to try out and. It uses artificial intelligence to create really readable articles, ones that kind of pass the smell test.
Well, not just articles. I mean, it's a language. It's like it's optimized. It's an AI. It's optimized for dialogue. You can ask it questions. You can have it solve problems.
Passable essays on English history in the 1600s, professional emails, and like so much more that it is worth mentioning because there are use cases I can't even imagine yet.
Yeah, and that's what we've been trying to figure out. Okay, what is the actual practical uses of this? Because you can do a lot with it. And one thing that I thought would be interesting for people watching this, watching the Gray Report is just like, okay, this is some things that we tried out yesterday. Yeah, and I'm going to talk about some because I don't have time to do all of it. But like one thing I asked was, what are if I can actually spell, what are 15 good video ideas that multifamily investors would, if I can type, would be interested in. All right, so it's like, all right, we need to come up with some content. Yeah. What give us some ideas. Okay, because like we could brainstorm here. We could come up with some good ideas. But it's like so it needs to know what a multifamily property is. It needs to know what multifamily investors would be interested in. And then it needs to see what would be popular. So again, just quick prompt. Tour of recently renovated multifamily property, highlighting the upgrades and improvements that were made. Interview with a successful multifamily investor, discussing their strategy. Yeah, discussion of the importance of conducting thorough due diligence before purchasing a multifamily property. The different types, how to calculate potential return on investment, video discussing the different financing options, this is like detailed, and this is not, they're not giving you a website of like, here someone else gave out 15 ideas. And I could have told it 20, I could have told it 5. Yeah. So for, again, this is just like on the marketing side, like what we do. This was an idea. But it can do so much more than this. So another thing I did yesterday.
Oh, we may have run into a limit.
Got a network error, and it's not perfect, and the server is completely swamped. But I think it was a good example to just throw out there. Yeah. So yesterday I was on CoStar, and I copied like 4,000 words of this CoStar report of like all this data and information, and I just pasted it all in the Chat GPT, and I said, summarize it in a blog post format, less than 1,500 words, and it just spat out a very concise, easy to read.
Yeah.
Like, these are the main points. Right now, so we're having may have seen people walking around. We're having a lot of our property managers on site today. We're having kind of like in-company kind of conference, and we're recording all of the meetings and having Google create transcripts for all of the meetings. Mm-hmm. And then we're going to take the transcripts of the meetings, put it in the chat GPT to summarize all the main points and identify action items from the meeting.
Yeah.
So we're going to see how it works, and just an efficient way to take notes. I think it's still a good idea to take notes. A lot of people learn that way and you might miss something. But the AI actually might be able to pick out some things that we missed.
Yeah. There are limitations, but the limitations don't feel good about yourself as a human because of the limitations, because they're going to get over them really quickly. I did want to know if it could do humor, and I copied and pasted this so we don't have to write this. I said, Judd, write a funny article about a world dominated by Chat GPT.
Oh.
And it said, in a future...
a short article.
Yeah. Well, no, this is just a paragraph.
Okay.
In a future dominated by Chat GPT, life would be a never-ending series of hilarious and unexpected conversations. Imagine walking into a restaurant and asking for a table for two, only to have ChatGPT reply, "Sorry, we're all booked up, but if you don't mind sharing a table with a talking dog, we might be able to squeeze you in." I'm going to pause for laughter on that one. Or going to the doctor for a checkup and having ChatGPT diagnose you with chronic punculosis, a deadly disease characterized by an inability to stop making terrible jokes. The possibilities are endless, wink, wink, and they're all completely absurd. So be warned, if ChatGPT ever takes over the world, we're all in for a wild ride.
And it wrote that?
Yeah.
It wrote, so...
Yeah, but it's not funny!
I mean, it's sort of... Yeah.
That's what it is. It is a generic thing.
But one of the use cases is like you're taking a different tact on it than like I'm taking. So you're like, write an article, write a story, write something that's funny. And like I was, which I think is like a really good, interesting use case. But then I also was like, okay, what is the best way to, build this table in Google Sheets or Excel? What is the and it laid out all the formulas.
And you were showing me this too. It makes code.
Yeah, I said, and it's the server's down, so we can't show everybody right now. But I said, write me a line of code that shows an apartment building with cash flow, with cash flow.
Yeah.
And it wrote a piece of HTML that I could drop into my website.
Yeah.
I asked it, which I wish it would work for this. I asked, what is the definition of a cap rate? Mm-hmm. It gave me one of the best. Simple, straightforward definition. I mean, it's an easy definition, but it's one of the better definitions I read for a cap rate.
Yeah.
I then asked it, what is the cap rate for multifamily apartment in Indianapolis in 2022? Which, like, big questions up in the air. Limitations of ChatGPT is it doesn't have any information post 2021.
Yep, because that's where all their archive is.
So they don't have like real time information, which it's not even attached to the internet. So this isn't like going out.
There is supposedly there is a version that goes out in the internet, comes back, but yeah,
and if it'd be really powerful
for sure.
But the answer it gave me to what the cap rate is in Indianapolis was a very correct answer.
Yeah.
Because I mean, first it said, look, like I don't know what it is because I'm not connected to the internet. I don't have real time information. But cap rate is determined by these different factors: location, cash flows. Here's the formula for it. And the best way to understand your cap rate is to reach out to a real estate professional.
Oh, so they didn't even tell you?
Well, they don't know.
A robot apologist.
It was a trick. It was a trick. Kind of a trick question because nobody knows.
Yeah.
But they still gave the right response because they told me they still told me like how to do it. They're like, you need to reach out to a professional in the market, which is always the answer of like if going bigger pockets. How do I find out the cap rate? Well, you talk to your brokers, talk to your lenders.
You're not asking the right question.
And so it's going to be really interesting. What applications are worth it? What aren't?
I that's what I said. To think that this doesn't touch upon the multifamily industry would be to deny the broad and powerful impacts this is going to have on the way that we communicate, on the way you were just saying, and this is part of some of the research that I was doing about this, is the way that people generate and use this as a generative tool for themselves and write it. It'll give you ideas. Maybe it won't write for you, but it'll get you started. Yeah. It'll help you do research. It may help you get past the 10 pages of Google links that aren't working. It'll get you right to information.
Yep.
Apartment syndication companies can have ChatGPT write up a bunch of blog posts. They explain how IRR is calculated, how distribution waterfalls work, or the differences between a REIT and a private syndication. Maybe you're working on a rebrand and you're getting your company started and you need a mission statement. I put mission statement for a multifamily investment company, and ChatGPT gave me like 5 of them. Like, it was excited to write it.
I got another one.
Because that is exactly the kind of generic response that they would love.
But the conversation we were having earlier, and which I think is important, is by using AI, they say you're going to get the average.
Yes.
You're not going to get the best. And so obviously most people aren't shooting for average. And so to make it really good, you still need that human element. But it could be a good prompt, good starter, good way to brainstorm. Absolutely. Good filler for things that aren't that important. But if you want yourself to stand out, your mission statement, Pacific, everyone uses the same AI for their mission statement. Everyone's going to have basically the same mission statement. But so that's where the human element comes in. But what is our mission? And you have to affect that and change that. But hey, give me some examples of mission statements to get me started. Is great.
I was talking to my 8-year-olds at dinner last night about this. They were like, I don't care. But I was like, you're going to use this to cheat on your high school paper soon.
I think it's going to be like Wikipedia.
Exactly.
Where it's like, usually you can't use Wikipedia. And like as students at the time, we're like, why? Why not?
But he did tell me. So one of my sons was talking about, he was like, do you know what the uncanny valley is? And I told him, and this directly relates to it in a roundabout way. It's when things look funny because they're not quite right. And I told him, like, your vision of what is uncanny and what's weird changes. I think that one thing is going to, it's going to change the way that people receive information as well. They will be able to tell, okay, this looks like it was an AI, and this looks like it's got some new stuff, some things that's just out of the ordinary, that it's not going to be caught within this the kind of more generic ChatGPT line of text writing.
Is like the byline going to be that much more important? Of like, is this going to be written by a person, and you're not allowed to fake it. Like, don't be using AI and putting your name on a byline.
It will
or is it going to be not by, but like prompted by,
with assistance from Chat? I don't know how that's going to be cited. I did ask for cited sources for like an article with cited sources, and they made up a source, but the author was a like professor of that field of studies, and the publisher was like right there. It was like. Again, that was the most uncanny. It was like, wow, this is like almost real and just fake enough to pass the smell test.
Right into the reports, though. That's fascinating because it's like, and it tells you it's like the limitations are sometimes it'll throw out things that aren't real.
Yeah.
So it's working again for a little bit. So I asked, what is a cap rate? Gave a very nice definition of what a cap rate is. But now I want to try and if this doesn't work, we'll just cut this out. But we need our video. I want to do what I did yesterday, which is essentially I'm going to take a video. One of our
let's do that 8-minute one because that might be easy.
No, I want to do.
You want to do a really long one?
I want to do a really long one.
Okay, then go to our.
Okay. If multifamily. Okay, so let's see if this is the right one. Yeah. So that's a great picture of me. So I'm going to go here and there's a little. You can hit the little ellipses. Show transcript. Okay. So this is automatically generated. So like not all of this is even like correct. Like they are misspelling Matt's like name wrong, and this is just using an AI or I don't know, whatever bot to take all of this whole transcript. This is a 50-minute which is whatever. It's just long enough with the timestamps and all of that. All right. So I'm going to ask this to please summarize the following transcript.
200 words.
200 words?
200.
And let's give it 250.
Okay. I wanted to keep getting smaller and smaller and smaller.
Words are less. Do shift enter. I'm going to paste this whole thing in.
While it's cogitating, I do just want to say one final thing. You know, I gotta.
It's already
okay.
done.
Oh,
man, it's already
dang!
So the Gray Report is a podcast discussing the latest news articles, research, and data related to multifamily real estate investing. In this episode, the host and guest, which when I asked to do longer, it included our names.
Oh, nice.
And it spelled your name wrong. Discussed the recent redemptions from BlackRock. It's Blackstone, but I think that was my fault. BREIT and Starwood. They explained that this is due to the difference in performance between public traded REITs, which have seen losses, and private REITs, which have reported growth. Discussion also covers the difference between public and private markets with a focus on liquidity and investor preferences. I mean, for 250 words, we just gave it a lot of stuff, and it was able to figure that out.
Yeah.
And that is a legible description.
Yeah, no, I agree. And this is just what I said is what I wanted to come back to is like I have a little bit of a complicated relationship with the idea of a robot writing things. You know, I went to school, it's like an English major, I got a PhD in literary studies because I cherish the way that a great piece of writing you really got a human connection between author and readers. And I haven't really fully come to terms with how AI assisted writing processes is going to change this connection. It's going to change it, but it is just a big question mark. But even with my vested interest in human authors, there's no way I'm ignoring this technology. And I think that it would behoove anyone, writers included, even if you still use a fountain pen, to figure it out. I'm going to keep using it, keep finding ways where it can help me and the team be more productive. And instead of running from it, I'm going to get good at it. I think that's the way to do it. And because I think that this is coming fast. And if you play around on ChatGPT, make a free account, you're going to see things that maybe don't look perfect, but I guarantee you there's another version waiting in the wings, and it's going to be bang on.
It's a tool.
Yeah.
It's a tool. It's no different from a hammer. It's how you swing it. And, the art is like the proper inputs and what you can do, knowing how to use it. I just want to try another one. I just copied the whole Yardi report.
Yeah.
I just Control A, and I'm going to Control A, Control C, Control V. Summarize the following report. And this is it's got tables in here that aren't going to be formatted correctly, so this could just come out all wrong. But let's put it to the test. All right. All right, let's show everyone what it looks like.
My favorite part of this whole Gray report was when I thought that
this is the input.
When I thought that it would take a minute for it to calculate, and it was done in 10 seconds.
Yeah. It's thinking.
Here we go. Man. The decrease is not a sign of it. I will say that I did this myself. I didn't have ChatGPT write my notes this time, but maybe I will. I think that
paragraph, whole report.
Well, and that's another thing too is if I just had it write that, I don't know if I'd understand the report with as much depth.
Yeah, well, there's no way you could.
Yeah,
there's no way you're going to turn a report into a paragraph, but still that ability to summarize, I think is quite powerful. Any other prompts? Again, I could do this all day.
Last night I wrote write an article or write about nuclear energy in the style of Mark Twain.
Oh, good article.
Nuclear fusion.
Nuclear fusion, in the style of Mark Twain.
I'll say,
which we didn't even get to nuclear fusion today, man. We're going to do that next week.
I'll say when I read it last night.
I gave it a question mark. I don't know. Sometimes I'm not sure if I'm supposed to ask a question or tell you.
It's such a caricature. It doesn't have it quite nailed.
Now I know.
Hey there, it's your old pal Mark Twain here, and I got a mighty fine.
But this is original.
About a little thing called nuclear fusion.
Now I know what you're thinking.
Maybe it's not like a perfect art.
No, but it's a tool. Every tool's got limitations.
Yep.
And sometimes the limitations
they're gonna get better. Yeah,
they're absolutely make it better. Sometimes the limitations and the flaws are actually where you can make real art by understanding those limitations. Mm-hmm. In music and in the audio world, it's imperfections are sometimes are desirable. Like distortion is desirable. And distortion is a destruction, of a signal and saturation of a signal, but it's like desirable. And understanding those imperfections and how to control them can be, a very powerful creative tool. And I think this is the same thing. And that's where you see on the AI art, it's actually kind of, it's challenging to be creative enough to figure out the right inputs. And like your input on Mark Twain about nuclear fission or whatever, like that's where the creativity in the human, where you're going to need the human input. Now, I'm sure you can get an AI to write the really good AI prompts too, but again, you're going to get the average. And I still think that, the human mind and humanity hasn't replicated.
Yeah, and there's still an appetite. I think that people don't want, they'd rather have something that's more real than more fake. And so I think that that's why I said it may change the way that things are perceived. There may be something that we're not kind of anticipating that refers to people's taste for I'd rather it was written by a human. But that could be wishful thinking. Maybe people are just like, no, just give me an article. I don't really care who wrote it or how it was written, but
I agree. So let's see how this works. Thank you for tuning in to the Multifamily Podcast, The Great Report. We hope you enjoyed this episode and found the information insightful we discussed to be valuable. If you have any questions or suggestions for future episodes, please feel free to reach out to us. We look forward to continuing the conversation, bringing you more content on the exciting world of multifamily real estate investing. Thanks for listening. We'll see you in the next episode. I would have done it differently. I had my own spin on it, but it works. We got the average. All right, thanks for watching this episode of The Great Report. Make sure you're subscribed to the Great Capital YouTube channel. You're giving us a like. If you like the show, a comment saying that I don't want to hear about AI. That's a buzzword, and I'm sick of it. But check it out. The next episode, and if you're a credit investor saying, besides AI, I want to partner with these guys on real estate investments, happy to have that conversation with you. Go to gray.fund and learn more. All right. Matt and I out. See you in the next episode.